Health and Beauty Co. or HBC is a global skincare brand who in 2014 began to lose market share in the hand and body lotion market and were looking for a way to rebrand in order to recover market share and cement themselves as a giant of the skincare game. They put their attention into advertising and repackaging, looking to create a new look for their product. Although the brand is a market leader, research found that the current packaging is viewed as outdated, generic, dull, and low quality, lacking that premium look of many of its competitors. Looking at the strategic rationale, many of the products in the skincare market offer similar benefits and ingredients, creating a very highly saturated and competitive industry. This is especially true in the last 10 or so years, with the market having grown by 4% annually in 2014, and the case stating that it's expected to reach 11 billion by 2018. For context, this year the US skincare market rose to $24 billion annually. Because of this, branding and branding is an important strategy for businesses to differentiate themselves from competitors and attract consumer attention. The timing is crucial in this case as a large competitor is set to launch a new product soon. To combat consumer feedback, the new packaging aims to communicate a modern, high quality, and everyday use brand image. This is expected to keep the brand fresh while maintaining its heritage and appeal. The strategy behind the redesign is ultimately to stand out in a competitive market and increase sales. HBC also believes the new packaging may improve profit margins through potential price increases, with management expecting sales growth from the combination of rebranding, advertising, and updated packaging. There is no exact timeline for this kind of project, but with the design process already underway, it's expected to see real results within the first year. The rebranding initiative began with market research and strategic planning and then a redesign idea. Next phases involve finalizing the new $2.42 million equipment investment. Then HBC would begin marketing rollout before the full launch. Post-launch, they'd begin performance analysis and monitoring, especially over the first 5 years after the product launch. In terms of an expected impact, HBC can expect a strong financial impact from this rebrand, as they hope this is the swing to gain back market share. Sales are forecasted to grow at 4% annually over the next 5 years, compounded by market share recovery of 2% in the first year, a 1% in the second year, and then 0.5% in the third. This should build towards a significantly higher sales base by the 5th year post-launch, which is huge compared to the flat trajectory they expect without the rebrand.
Next, I will present the financial evaluation of this packaging redesign project. In this case, we use three important indicators. The first one is NPV, net present value, measure how much the value the project create after considering the time value of money. And if it's positive, it means the project is profitable. And second is the internal rate of return. IRR is the discount rate that make the NPV equal to 0. And if it's higher than the company return, the project is considered financially attractive. And the last one is the payback periods. Measure how long it takes for the project to recover the initial investment. A shorter payback period means lower investment risks and faster cash recovery. Now let's move to the project cost. The company needs an initial investment of approximately $6.32 million, and this includes the capital expenditures, startup costs, and marketing and development costs. And next, let's calculate the profit generated by the project. Without the redesign, annual sales are expected to remain flat at $139.5 million. However, with the redesign, the company expected both category growth and market share recovery. And as a result, project sales increase significantly over the next 5 years. And to estimate the profitability, we first calculate the incremental revenue. And then using the company's gross margin of 69%, we estimate the incremental gross profit. And at this stage, an important term is EBIT, which stands for the earning before interest and taxes, and it reflects how profitable the project is from the normal business operation. And in this project, EBIT increased steadily because the sale continued to grow, margin remained high, and the company also saved the packaging cost through the SKU reduction. And after subtracting the taxes, we estimate the net income. And then by adding the depreciation back to the net income, we get the operating cash flow. And based on the cash flow, the project produced an NPV of approximately $38.9 million. It's positive, which means the project creates shareholder value. And then it creates it have an IRR of around 111%, which is far above the company's 7% required return, indicating very high profitability. And the last one is payback period is only about 1.2 years. It's very short, and because the company can recover its cash very quickly. And the results are very strong. And in conclusion, the rebranding project appeared financially very attractive.
Okay. Along with the reform of the brand, there are some financial and non-financial risks. Let's talk about the financial part. The first one will be the upfront cost uncertainty risk. The project involves significant initial cash outflows, including capital expenditures, startup costs, and market research expenses. These costs are based on estimates and may fluctuate under different circumstances. And the second one will be revenue growth uncertainty risk. This means that the project assumes future revenue growth driven by market recovery and brand repositioning, originally estimated at 4%. However, this assumption is uncertain and may be affected by market conditions and competitive pressure. And let's talk about the non-financial risks. The first one is brand perception risk. If consumers perceive the new packaging as a deviation from the brand's traditional identity, it may weaken customer loyalty and reduce the effectiveness of the rebranding strategy. Trust in the rebranded company will also take time to be rebuilt. The second one is retailer acceptance and competitive response risk. Major retailers and pharmacy channels may face some disruption during the packaging transition, such as returns issues or short-term supply efficiencies, which could affect shelf placement and restocking. Competitors may also react with more promotions or new launches, while our brand is making adjustment, which could slow down our expected market share recovery. And here are the sensitivity analysis. The sensitivity analysis shows that changes in upfront cost have only a small impact on the project. For example, a 10% increase in initial investment reduces NPV only by about 1.6%, since this cost happens in year zero and does not compound over time. In contrast, lowering the market growth from 4% to 3% has a much larger effect, cutting NPV by around 25%. This is because slower growth reduces revenue every year, and the impact builds up over time. Overall, the project is far more sensitive to market growth than to cost changes. Now, I would talk about the scenario analysis and explain what does those analysis means for the project. In the first one, the base case, which reflects management's forecast, the category grows at 4%. Market share gradually recovers over the next 3 years, and the gross margin stays at 69%. Under these normal conditions, the project generates an NPV of about 38.9 million, which indicates that the packaging redesign is financially attractive if everything goes as expected. And in the second one, the best case, the environment is more favorable. Category growth increases to 5%. Market share recovery is stronger, and company successfully raises prices, improving the gross margin to 72%. Upfront costs are also 10% lower. Under this optimistic scenario, the NPV rises significantly to nearly $58.4 million, showing the strong upside potential for this project. And even in the worst case when conditions becoming challenging, category growth slows to 2%. Market share does not recover as anticipated, and competitive pressure pushes the gross margin down to 65%. Upfront costs also increase by 20%. In this situation, the NPV drops to $7.6 million, which is still positive, but much closer to the break-even point. As conclusions, this investment is still financially strong when things do not go as planned. The best case scenario shows that there is meaningful upside, but the key point is that the project remains viable even under the worst case scenario. Overall, this scenario analysis suggests that this reform is solid and can hold up across different market situations.
So now we're here to talk about the ethical considerations of rebranding. From a positive side, branding itself can be part of the value of a product. Customers are not only buying skincare product itself, but also for packaging design, user experience, and emotional satisfaction. Also, the pain point is the premium feeling to connect to the brand. In the skincare industry especially, many customers not only care about the moisturizing performance, but also the feeling of confidence, comfortable, and well cared of. In fact, raising the price through better packaging and stronger branding is very common in the beauty and skincare industry. Many successful skincare brands spend a large amount of money on a packaging design. Therefore, even the product formula does not change much, improving the brand experience can still create real value for customers, and they are willing to pay for it. As long as HBC does not make false claims, exaggerate product performance, or hidden ingredient information, customers can decide whether the redesigned product are worth or not to buy. From this perspective, rebranding can be seen as a normal business strategy rather than an unethical action. And now let's jump to the ethical concerns. One major issue is that company may rely too much on customers' reaction to premium packaging. Even the actual product quality does not improve, customer may believe that product is better simply because it looks more expensive or modern. In this situation, purchasing decision might be influenced more by marketing and appearance than by actual product improvement. This issue is especially important today because the internet makes information such and transparent. Many customers may now check ingredient lists, watch online reviews, and compare the product through beauty influencers like KOL or skincare reviewer. If customers discover that a product has similar ingredients to cheaper another option, but is sold at a much higher price because of the branding and packaging, our brand, HBC, might be criticized as a beauty tax or IQ tax. Modern customers are more informed than before, so companies cannot rely on misleading marketing for a long time. Another concern is environmental sustainability. HBC's redesign project requires about 2.42 million in capital expenditure, and it's about 3.2 million in startup and transition costs, including the product returns, packaging replacement, and launch costs. This means the old packaging material and inventory might be discarded, creating additional waste. The company also recognized the risk that existing customers might not accept the new brand image. If redesign changed the brand identity too much, loyal customers might feel disconnected from the product, and rebuild trust can take time. After talking all about, we generally agree that we should launch the HBC rebranding project is because according to our scenario analysis, even under the worst financial situation, the project still produced a positive NPV of about 7.6 million. So that means we should launch it, right? However, we believe that HBC should market the redesigned product honestly and transparently. If the product formula has not significantly improved, the company should not suggest the product performance is dramatically better. Ethical rebranding should focus on improving customers' experience and brand value honestly, rather than manipulating customers' perception through packaging alone. And here's all of our presentation today. Thank you so much.